Morning, everyone. This is Barry Knapp with Ironsides Macroeconomics. It's Monday morning, May 24th. Our podcast and YouTube video will be based upon a note that we released on the 22nd titled Follow the Money. I'm back in Colorado after a 10-day East Coast trip. As you can see from my background, there were four sections to this week's note. The first one was titled Crypto Crash, The Empire Strikes Back. The second one was Follow the Money, which is the main theme of the report this week. We then had a section, was a data review about all the bottlenecks that we're observing in different sectors of the economy. And then finally, we did a little book review on the Bitcoin standard, which is a monetary argument for Bitcoin as digital gold. So beginning with the crypto crash, one of the obvious criticisms or pushbacks on the Bitcoin digital gold standard is that the world's sovereign nations, including the US and China, will only give up their, or will not really have any interest in giving up their monopoly over printing currency that they really only gained after the gold standard collapsed. So this is not as if they've had this monopoly on currency for centuries, but nonetheless, it's a powerful monopoly, and that they're going to push back on it. And that was clearly part of the narrative about why Bitcoin crashed last week. But we think that the real conditions or necessary conditions for the Bitcoin crash has more to do with expectations around the deficit financed spending blowout of the Biden administration. The Fed policies, which are clearly loose and were at the core of the Bitcoin thesis in its very early days, going back 10 years or so ago, now have been loose since the early stages of the pandemic, incredibly loose. I think loose is probably an understatement. But the real surprise that turbocharged Bitcoin in the first quarter was the blue wave, followed by the 1.9 trillion of spending in the American Recovery Plan. And since that time, those spending plans have run into heavy weather, if you will. The bipartisan negotiations are for a much smaller bill that would be funded with user fees. And so I'm going to come back to this topic in a minute, because I do think it relates to how you think about the broader reflation trade. Nonetheless, that's really for us, these slowing of expectations around deficit finance spending blowouts is really what created the conditions that caused Bitcoin to crash and there to be a reversal in some portions of the fixed income market. So moving on to our section we titled Follow the Money, the basic argument here is that, yes, we had a little bit of a taper tantrum preview last week when we got the minutes of the FOMC meeting. Following that, we saw the incredible divergence that we've been describing between inflation break-evens and real rates stall out and even reverse to some extent. We've been focused on the 5-year part of the Treasury curve because that's where the Fed purchases are concentrated. Their average duration is 6 years, and we'd had the lowest real rate for 5-year tips that we'd ever seen in the history of those securities going back to 98, and the just about the pretty close to the highest level ever for the inflation break-even or market implied inflation component of 5-year nominal Treasury yields. After that Fed meeting, that started to reverse somewhat on expectations that the Fed may taper. Now, we don't really believe the leadership is particularly close to wanting to do that. We always thought that they were going to look through the second quarter data. There are probably at least 2 very strong payroll reports away from doing that. Recall that those meetings, those minutes of that FOMC meeting took place before that disappointing April payroll report. So a week from Friday, we'll get another one, but we'll need at least 2 strong ones before the leadership comes in line with some of the regional bank presidents that have been talking about tapering. The real issue here is the next surprise is likely to be a positive liquidity or spending shock, in as much as we think that the bipartisan negotiations over infrastructure are on the verge of collapsing. We were just listening to CNBC interview Transportation Secretary Buttigieg, and he was saying, well, Memorial Day is kind of a deadline for the Democrats. There's been pushback from the Wall Street Journal on the Republican side. We just never thought that this was particularly viable, that the progressive wing of the Democratic Party will push hard on the Biden administration to go the reconciliation route. That'll happen likely in early June. When we see that, it's likely that that Schumer will file for at least an additional one, if not perhaps as high as $2 trillion of expansion of the budget deficit. So additional unfunded spending. And that we think will restart that whole reflation thesis, which has been so evident, particularly in the very long end of the Treasury market. If you observe 30-year real rates, they bottomed in August at negative 47 basis points. By the beginning of January, even though we'd had rates move up in most of the Treasury curve, that 30-year real rate really hadn't moved very much. It was still negative 38 basis points. Between the point when the Democrats took both of the Senate elections in Georgia and the middle of March, when the American Recovery Plan was signed, that jumped 60 basis points to plus 20. It's now settled back to about zero as those, as I've said, the pushback has begun on the Biden spending plans. We would expect that if they do go the reconciliation route, file for an additional $1 to $2 trillion of deficit finance spending, you'll see that part of the curve jump again, and that will restart a lot of these reflation themes that will probably even include Bitcoin. Not that that's the focus of our work, but just as a canary in the coal mine, so to speak. So that's how we're thinking about the liquidity outlook from here. Yes, there's going to be a taper tantrum sometime around Labor Day. We still think Jackson Hole is the most probable outcome for that. And we're going to talk about how we think you should hedge for that. But the next shock is likely to be a positive one as the bipartisan talks collapse, not a negative one when the Fed starts tapering. So on to that idea about hedging, we still think, we've written a little bit about this, but we still think the best hedge on the board is to buy puts on bonds. One of the most efficient ways to do it is through ETFs. If you want to hedge long-term rate risk, this idea that we would have additional government finance deficit spending and we'll have a big move in the back end of the curve, that would point you towards the TLT ETF. The belly of the curve where the Fed operates is IEF. That's the intermediate term Treasury ETF. But a trade we really kind of like is some of the corporate bond ETFs, LQD being one of them, because typically you would expect, if you had this sort of a taper tantrum, that credit spreads would tighten as interest rates went up. In this case, we actually think the opposite will occur, that credit spreads could actually widen somewhat as you have a broader risk-off episode, and you'll have rates go your way. Remember that volatility is suppressed by Fed purchases of mortgage-backed securities. If they were to do anything at all in June, we still think this is a low probability, it would be to reduce the mortgage purchases and reallocate that to treasuries, because they are buying 100% of the net supply of mortgage-backed securities. And it's pretty clear that they've turbocharged the housing market. We're going to get some house price data this week that'll provide further evidence of that. It's a little stale because it's March, but nonetheless, we know from the existing home sales numbers last week that they are clearly turbocharging house prices by pushing mortgage rates, the spreads, and volatility to levels that are incredibly low. That brings me on. So again, the reason for buying interest rate puts on the Treasury market or investment grade corporate market is because that's how we think a risk-off event will start. Much like 2018, when we had a couple of shocks in real rates, one in January that was followed by Volmageddon in February, another in September that was followed by the QT crash in the fourth quarter. That's the best marker to have down, is to have puts on treasuries or interest rate securities like investment grade credit. that will start a risk-off event in our opinion. So moving on to the section on bottlenecks. Through the data last week, we saw bottlenecks evident in the jobless claims market, where initial claims continue to fall, but continuing claims do not. This is a bit of a bottleneck in the labor market attributable to expanded unemployment benefits. More and more states are dropping out of that program. That should help a little bit, but the problem really has been that the lockdown nation coastal states are unlikely to do that. So until that gets rolled back, we're going to have a bit of a problem in the labor market. So that's bottleneck number one. Bottleneck number two was evident in the manufacturing sector through the regional Fed surveys we saw last week, the Philly Fed and Empire State survey, where you could see supplier deliveries slowing down, backlogs growing, prices paid going up. Again, lots of bottlenecks in the manufacturing sector of the economy. And then finally, in the housing market, we had housing starts slip a little bit, even though permits are quite strong. Existing home sales are not all that robust because inventories are low, prices are strong. So again, sort of bottlenecks, and we think Fed policy is probably exacerbating that. And then final note in this week's report was a bit of a book review of the Bitcoin standard, which we found a fascinating monetary argument around why we could have a new standard for money developed outside of these very central governments that clearly don't want it to happen. But one of the things we were kind of shocked by at the end of that book was that author argued that often you hear Bitcoin may not be the killer app for blockchain technology. And the author actually argued that blockchain might be the only app that makes sense for that technology, and that technology might be particularly inefficient or ineffective and not work for all these other applications we're talking about, things like Ethereum and the like, which we found a fascinating argument. We think the book is worth reading, if only to follow the monetary policy history and think through the monetary argument and how this could happen unwillingly to governments. But it's a good read. We were just kind of stunned by the ending of the book. So anyway, that's it for me this week. Again, we think the next liquidity surprise is likely to be a positive one as the Biden administration spends more. We don't think that their programs are particularly well crafted. We don't think they ought to be hiking corporate taxes. None of this is a normative statement. We just think this is how the markets will react. And one final note on the cover of this podcast and channel, you're going to see earnings net revisions in the S&P 500 are surging to their best levels of the entire recovery. We had thought we would trade in a bit of a range for the S&P for a month or two until we got to next earnings season. And instead, revisions continue to move higher. So this is providing very good underlying support for the equity market. This is why we think until we actually do get a tightening of monetary policy, that downside in the S&P is very limited, 4 to 6% pullbacks, sentiment-based pullbacks, but the broader trend is still higher. So that's it for me this week. Barry Knapp from Ironsides Macro. If you're not already a subscriber to the podcast, please become one. Subscribe to our YouTube channel so you can see the video version of this, or please, by all means, consider becoming a paid subscriber to our written research. That's where the really good stuff is. So Barry Knapp, Ironsides Macro. Thanks.